you're a business owner in New Brunswick, you know that making money is only half the battle. Keeping it is where the real work begins. Today, I'm sitting down with André Carroll, partner at Cox Palmer and a former tax law educator. We're pulling back the curtains on high-level legal strategies that most owners miss until it's too late. We're uncovering when it's time to graduate from simple corporations to holding companies and even family trusts, and how to use the New Brunswick Small Business Investor Tax Credit to effectively double your investor's rate of return. We also dive into the business partnership prenup, the non-negotiable clauses you'll need in your shareholders agreement to protect your wealth if a partnership doesn't go as planned. If you want to ensure your business is structured for a tax-efficient exit or a multi-generational legacy, you don't want to skip this episode. So let's dive in with André Carroll. All right, and we're live. So today I'm super stoked to have my good friend André Carroll in the studio. How are you doing today?
Pretty great, Marcel.
Yeah.
How about you?
I'm doing great, fantastic. So let's dive right into. Tell us a little bit. So you're a lawyer with partner, actually, with Cox Palmer. You've been there for several years now.
Yeah, just about 6 years.
6 years, yeah. And tell us a little bit about Cox Palmer, your practice, who do you work with, and yeah.
So the practice is, I'd say, general corporate commercial.
Yep.
It does entail some wills and estate and some real estate as well.
Yep.
It kind of ties into that those corporate and commercial areas. I'd say I'm working closely with a slew of industries, so it's really, really varied. We'll talk anywhere from construction to nursing home to some small startup in the app industry, for instance.
Okay, like tech.
Yeah, exactly. So
Yeah.
really varied. And then the people I work closely with are also tax advisors and accountants.
Yep.
And then, obviously some lenders,
Yeah.
including institutional, but also including investors. So
Wow,
people
like
that
private?
will yeah, exactly.
Private. Okay. Interesting. So tell us a little bit about yourself. Like, how did you become a lawyer? Like, where are you from? Where'd you go to school? And how did you end up here advising people with their legal issues?
So I'm from Grand Falls, New Brunswick.
Shout out.
Yeah, there you
the
go.
crew
Grew
there.
up there.
Yeah.
Picked up a lot of rocks and potatoes in those fields while growing up, so it
I
entails
bet.
some sense of, good workmanship, we'll say.
You and many of our
Hard work.
friends, I think.
Yeah, exactly.
Yeah.
Yeah. So a good background there. Did various jobs growing up, and then the debate became, do I go to university or college and all that. I picked university mostly from a conversation with a good brother of a good childhood friend who
Okay.
was a lawyer, and kind of encouraged us to go do that. So
Okay.
I picked a degree in finance,
Mhm.
where we met.
Yeah, that's right. We studied together. I was like, yeah, we did do a lot of courses together.
Oh yeah.
Yeah.
A few projects, and anyways, so did that, and then I went to work for the CRA for a year, which opened my eyes to kind of what they were doing and instilled some kind of an aspect of, or some kind, I'd say, of an intrigue into tax law.
Okay.
I already knew I wanted to be a lawyer, so I
Right.
just went on to law school,
Okay.
and then I kind of focused a bit more towards corporate commercial and some tax law component as well.
Yeah, because if I read this correctly, you did kind of specialize or did extra studies in tax law,
Yeah.
right?
Yeah.
Okay, cool.
Yeah.
So let's start with the basics. Me and you have worked on several business cases together on different projects, and we continue to work together on certain businesses. And we definitely appreciate your advice and your guidance on a lot of these things. But for the listeners who might be new to corporate law, or even are just starting off with their first business. They're drafting up a business plan, or even longtime business owners who might not know all this stuff. Can you explain what a corporation in Canada is and why it's important for business and personal planning?
So there's two big aspects. So I'll explain these in detail after I explain what the corporation actually is, which is kind of its own person, we'll say. It's its own box. It sits really separately from the owners, which are the shareholders, the directors, which can be the same people, but they're the ones that kind of manage the affairs of the business from a higher level. And then we have some officers who will manage it more from a day-to-day perspective.
Yeah.
Okay.
Right.
The biggest reasons why you want to incorporate would be from a risk perspective, because it's its own person.
Yeah, it's its own entity.
Yeah, exactly.
Thing.
Its own entity, exactly. Yeah. So basically, some liability, some risk will remain in the corporation. There is some exceptions to that if there's fraud, negligence, or stuff like that. Yes. In which case, they do what's called lifting the corporate veil, or somebody could claim that.
Yeah.
And then they step away from the corporation, and then they can go after the individual. It's really rare, we'll say.
Yeah, okay? It's extreme.
Yeah, so if, let's say, then something happens with the corporation, with the business or whatever, and then the corporation gets sued, well, it'll stick with just the corporation.
Yeah.
Minus those exceptions that I mentioned.
It's like the debts.
Yeah, exactly. It could be debts. It could be some lawsuit regarding some project that was done that didn't go well or something like that. And then the other reason is for tax planning, we'll say, or tax savings.
Yes.
A corporation will be taxed at a lower rate than an individual. Sure. And we can talk all the way from, it could be like almost as big as 20 to 30% in terms of the variance for the same amount of money. It's not, it also means that the money is not going to be used. Sometimes it's going to have to stay in the corporation, but that would be the other big reason.
Yeah. Another one that I've kind of advised clients as a reason to consider corporations is as soon as you're not the solo owner. Like if it's a one-to-one, I'm the business owner. It's my personal decision whether I want to run it within a corporation structure, separate it from myself and manage the tax that way. Or if I just want to be in business for myself, I can still name my business whatever, but I am the business.
Yes.
But as soon as I introduce the third party, meaning I have a 50-50 partner, or I have, several partners, I have investors, then I believe a corporation is usually a good way to distinguish who gets what share of the pie, right?
Yeah, exactly. So you can do that in various ways. One of them would be just by, the pure share ownership. So it could be like, it could be 50-50, like you said. It could be 30-70 or something like that. Which will give you various rights, various obligations, and all that. And then you can also put in place what's called the unanimous shareholders agreement, which will dictate the rights, the obligations, the responsibilities of the various shareholders and directors.
Yeah. So what specific milestones should a business owner upgrade from a simple corp, like my business is a corp, to something where we see often with holding companies or a family trust? So at what point do you want to add layers of complexity or multiple corporations around an individual or a business for tax purposes?
So I'd say like the biggest piece would be, usually it's there, again, we go back to those two parts, the risk and the tax piece. Right?
Yeah.
So if we ignore the risk piece for now, right, because you can always get insurance for that, so you can minimize that risk anyways.
Yeah.
If we go to the tax component, well, that's where, like, once you hit a certain threshold in terms of revenues, and you're going to keep some of those revenues in the business mostly.
Because you don't want to get taxed personally.
Exactly. Yeah. That could be one big reason. In that respect, that's where, Marcel, I'll tell you, like, somebody who wants to look into that should go talk to a tax advisor or an accountant, right?
Yeah.
Because they'll be able to give you that threshold. And there used to be like this rule of like, oh, if you're over like 100 or 120, go incorporate. I don't think that's necessarily true.
I don't agree.
Because it all depends of how much money you're going to keep again in that corporation.
Yeah. If you're going to make 120 and spend 120, the corporation is not necessarily the way to go. Like, it's a lot of fees and accounting for nothing. Yeah. I agree. What about like multiplying corporations. So like, let's talk about maybe if we're like purifying a company, or can you talk to that about like
Yeah.
what's the purifying a company means,
Um,
how it's used?
so you could basically, if you want, you could, um, kind of keep only certain assets, we'll say, in a company
Yeah.
or in a corporation,
Hmm.
right? And a certain type of business, we'll say, in that corporation. So what you're doing now is that you're ensuring that the risk for that type of business stay there. So let's
Right.
say you have, and then there may be some, again, tax component, just to get on that again, but
Yeah.
um, if you have a business, let's say, of like it could be OnVisor, for
Yeah.
instance, right?
Hmm.
So you have that type of business, and then you have a CrossFit DM, for
Yeah.
instance, right?
Hmm.
So they're really two different types of businesses. You don't necessarily want to mix all of those assets
Hmm.
and all of those revenues together,
Or debts
right?
and all
Or
that
debts
stuff.
and all
Yeah.
that, right? So that would be one good reason to just separate
Hmm.
these all together.
Hmm.
That example is a bit easier,
Yeah.
right? We'll say, because it's really two distinct companies in two
Yeah.
different areas altogether. Sometimes it's not as easy to distinguish if you're building an app and you decide to go build another one, or do some kind of project in intellectual property or
Yeah.
technology as well. It's kind of the same thing.
Hmm.
So the debate will be, well, do you want to keep it there or not?
Hmm.
The issue is that if one side of the business blows up, you might want to get it separate from the other side.
Yeah. And in the case of holdcos versus opcos, so and for those who don't know, holdco is kind of a corporation set up just to hold assets,
Hmm.
investments, real estate, otherwise. And opcos, operating companies, are usually the businesses you were kind of referring to as the ones that operate. They run a business, they run a gym, they run a financial planning practice, they create apps, etc. Um, am I correct to say that often holdcos are set up if to hold the profits or the assets that people want to detach from their operating company? That's pretty much the essence of it.
Yes, definitely. And so one of the big things with that, or the big aspects, would be basically what you're doing is you're taking the revenues or the profits really from the opco, the operating company, and you're removing them, putting them in the oldco, so that there's less risk of that money being attacked, we'll say.
Yeah.
So let's say there's a lawsuit at the business or opco level. Well, the people are going to go, they're going after all the money that's in there. If the money's been flipped out, right? There's certain rules around that and everything,
Yeah.
but the money's been brought up to the OLCO, then it's somewhat more protected,
Hmm.
right? And then that money, to your point, can be used to do some investment. So
Yeah.
you can build a portfolio out of that. Under the OLCO, you can also have all of those multiple other businesses. And
Yeah.
then on top of the OLCO, you'd have that shareholder, that group of shareholders.
Yeah. Exactly. Yeah. So holdco is usually the next step for business owners that have a certain level of like profits
Mhm.
left over, maybe from several companies. The holdco can kind of capture those, and then we can set a plan for those to be invested and used in different, like you said, various portfolios. Now, the next degree after that, most people, most successful business owners, at least in this corner of the world, if they have their operating company, they have their holding company, they can usually get away with most transactions they're going to do, whether it's selling the company to their family or whatever, sell the company, take the profits, put it in the
Mhm.
holdco. For some people who are building like intergenerational wealth, we're talking about money this guy or couple will never spend. Usually, we start talking about family trusts,
Mhm.
right? Can you kind of maybe talk to the bridge between just the holdco, where you can hold unlimited amounts of money for your own benefit and even your family, but there's a whole other level of planning with family trust. Like a family trust, from my understanding, is kind of more of an umbrella where the family are kind of the shareholders or the beneficiaries
The
of the trust.
beneficiaries, yes.
Um, and basically, yeah. So can you talk about that and just a little bit?
Yeah, so the family trust can, to your, like you said, is definitely just, so basically you'll have trustees. In New Brunswick, we need 3 trustees. They're kind of somewhat the equivalent of directors in a corporation,
Okay.
if we want to compare it to something
Yeah.
else. Those trustees will be the one that kind of direct what's being done with the trust funds,
Yeah.
the revenues and all that, and the capital.
Hmm.
And then under that, instead of shareholders, we'll have beneficiaries.
Yeah.
So money will flow to them per the direction of the trustees. Usually what happens is that that trust will own some corporations
Yeah.
or some shares in a corporation. So some profits from those corporations will flow through the trust to the beneficiaries. What
Right.
you don't want to do is leave the money in the trust because you're going to be taxed at a way higher rate.
Yeah.
There's a big risk there.
On an ongoing basis, right?
Yeah.
Yeah.
And and I'll say this generally because there is a few exceptions with those those trust funds and all that. So minor children's, for instance, and stuff like that. So you flow money to them, it could be you could again be taxed at a higher rate.
Yeah.
Even though it went to a minor who's supposed to be taxed at a lower rate.
Yeah.
But generally, you can flow those funds out. You flow it to adult beneficiaries, and then you can basically distribute the funds from that corporation. Another big reason to do that is for what's called the capital gain exemption.
Yeah. Lifetime capital gains.
Yeah, exactly. Which
Mhm.
right now is over, I can't recall the exact number, it's over $1 million, right?
Yeah.
And basically what that means is if you sell the company or you sell shares in the company, again, subject to certain tax criteria,
Rules. Yeah.
when you do that, you can basically multiply the capital gains exemption. So you sell the company, you get a capital gain, which is basically you're gonna be taxed on 50% of
So
what
far.
you sell.
So far.
Yeah.
Yeah.
So, but then if you go through a trust, and the trust is actually one of the shareholders, you can distribute that to
Mhm.
those beneficiaries. Right?
So in essence, it's a way, if properly done, and also I'm going to add keynote here, properly motivated. Obviously, I think there are rules, CRAs. You can't just set these up on a whim the year before you sell your company, because it's obvious you're just doing it for tax avoidance a little bit
Yeah.
at this point. But if you're doing it in preparation, in foresight, while you're still building your company and there's no real signs of a sale or whatever, I think it's a really effective way to, essentially multiply your lifetime capital gains exemption. So instead of me having a $1 million lifetime capital gain exemption based on maybe several businesses I might sell, I basically get to apply the same $1 million lifetime capital gain exemption to multiple beneficiaries under the umbrella of my family.
Exactly.
Right?
Yeah.
So it's a great way for business owners to really strategically plan their exit. If you're thinking of intergenerational wealth, it's good. It's costly though, right? Like it's a costly venture. You need to be careful.
Yes, and that's a good point because I was just thinking about that, and especially even the first few steps we talked about, right?
Yes.
From an individual owning,
Corporation.
even just its business, right? Just owning a business name, for instance, and then just having a business without a corporation,
Mhm.
right? Fairly low in terms of cost, right?
Very
You might
low.
register the business name and that's it.
Yeah.
Corporation, well, then you're adding the accountant, you're adding the lawyer,
Bookkeeping.
and I recommend that you do anyways. It's not
Yeah,
absolutely
yeah.
necessary, but
Yep, I
you know,
do.
so you can move just from that. You can move from almost nothing to $4,000 amongst them, and that's not counting the yearly remittance and the yearly reporting that you need to do, which can pile on a few more $1,000s every year.
Yeah.
And then obviously if you do a reorg and you want to free some assets and all that, flip them in more corporations, do a Holdco, do a family trust, while you're piling on and piling on.
Dozens and dozens.
Yeah,
Yeah.
exactly. So you need to really consider whether it's appropriate for you to do it from the get-go. Some people will definitely want it that way.
Mhm.
Some people will say, well, let's see how it goes before.
Yeah.
Which is what I'd usually recommend, right?
Mhm.
Just because you want to make sure that the business is actually going to be profitable enough and is going to sustain those costs plus the tax savings and everything else that you want, right?
Yeah, it has to make sense at the end of the day, and usually a good advisor will be able to help you, even a financial advisor, like not being a lawyer, not being an accountant. I know enough of it to say, like, well, yeah, you should be considering this or you should be considering that. Go talk to Andre or go whatever, do your due diligence, but, you're at a certain level, like, yeah, it makes sense. Another thing I wanted to bring up is the idea of governance. So you talked about directors, trustees, all these terms, and that pretty much all relates to governance. Who's going to govern the entity, whether it's a corporation, a trust, a nonprofit, for instance. Can you talk about governance, and not only for we think of governance like a big public company like TD
Mhm.
Bank, but even for small, medium-sized enterprises, can you talk a little bit about why it's important, and even if it's just a family-run company?
Yeah. So I'd say, like, from experience, the biggest component of governance would be, I'd say, and it might not have been that initially when I started practicing. What I'm looking at now is more expectations. So basically, what you want to do is to set expectations from the onset amongst your partners, directors, and officers. So there's a few layers to that. So if it's amongst shareholders, like I mentioned earlier, you can put in place what's called the unanimous shareholders agreement.
Mm,
That's a fancy term for a big document that's going to really just dictate the relationship amongst those shareholders.
yeah.
Um, it's going to set up, okay, like, or it's going to explain or dictate who's going to be a director, which is going to bring us to some other later points. But
Yep.
who's going to be a director? Who's responsible to do what?
Hmm.
How can you take money out of the corporation? When do you need to put money in the corporation? If there's a dispute, how can it be resolved? If one shareholder wants to get out or even wants to push the others out, how can it be done?
Yeah.
Right? So everything is basically pre-planned, if you want, in that document. So what you're doing is you're setting expectations from the onset
Hmm.
instead of waiting until something happens later down the road.
Yeah.
So you're having these difficult decisions or these difficult discussions early on.
Ahead of time
Exactly.
before it hits the fan.
Yeah. Yeah.
Yeah, I totally agree with you. I think that's probably one of the biggest mistakes people make is going into business without a comprehensive shareholder agreement. And even with a really solid shareholder agreement, it still hits the fan
Yeah.
sometimes. And luckily that's there because it at least sets the groundwork for how it's going to go down. How can somebody prepare and approach their side if things
Yeah.
if things get polarized, if
Yeah.
owners start disagreeing, um, and things seem to maybe hit an imbalance at some point. It can be tricky, and it gets it gets messy some quick because all of a sudden emotions are involved, money's involved, true colors come out sometimes.
Yeah. And it's, sometimes these businesses are set up with good friends or family members and all that, right?
Yeah,
So it
exactly.
adds a layer of complexity to it.
Yeah.
I'll say, like, the agreement can be somewhat general, and I kind of jumped to the dispute part there, but
Yeah.
it also dictates, again, what can and can't be done. But at the end of the day, you don't want to, you want to have a good relationship with the
Hmm.
shareholders or amongst the shareholders before you go to that document, right?
Yeah.
Or before you're trying to use it,
Before
basically.
you're waving it around.
Yeah, and
Yeah.
then that kind of leads us on to governance amongst the directors. So that is, again, just really sharing responsibilities, and again, we can talk about expectations if in a way, but it's basically the directors are basically just they're gonna in a way run the company from a higher level, right?
Hmm.
So they're not going to dictate the employees or the management's every actions,
Yeah.
right? Um, but they're just going to look at them from a higher level.
Yeah.
Okay. Um, and so, it's important for them to, one, get along. It's important for them to know exactly what they need to do.
Hmm.
And in that respect, we're usually going to go to the corporation's bylaws or the company's bylaws,
Right.
right?
Yeah.
Which will dictate, again, what they can and can't do, plus some legislation involved in that, obviously. But
Right. And the bylaws, that would be something that is usually in place when you set up a corporation
yes,
properly, right?
yeah,
I don't think they're always in place, but are they always in place?
they should be. Yeah,
Okay. Yeah.
yeah,
Okay.
yeah,
See,
yeah.
there you
No, they
go.
should
That's
be.
why you
Yeah.
hire a
So
lawyer.
it's basically like the few steps are, like, if we want to go back to how a corporation is set up. One, you'll have the articles of incorporation.
Right.
They're kind of the birth certificate, if you want.
Right.
Okay.
Okay.
Then the bylaws are like, it's essentially like those rules of, for an individual would be equivalent to how you're supposed to act in society,
How we
basically.
want to show up.
Yeah, exactly. So
Yeah.
it's kind of that, but for the corporation, for the directors, the shareholders, and all that.
Okay. Okay. So general rules of conduct.
Yeah.
Um. All right. Let's jump into some tax questions. So there's an interesting program in New Brunswick. Not sure if people know about it. If they don't, they should. So, and it's called the Small Business Investors Tax Credit. Can you explain a little bit what that is and how it helps business owners attract local capital?
Yeah. So that program was essentially put in place. It must be over 25 years now.
Already.
Yeah. It was souped up at a certain point, maybe 10, 15 years ago.
Okay.
So meaning that some percentages were increased, we'll say,
Yeah.
to give more advantage, and I'll explain what that means. But basically, the program is to encourage local investment in small businesses.
Yep.
Right, small corporations. So one of the criteria is you need to be a corporation. You need to want to raise at least $10,000.
Mm-hmm.
And each person or investor that's going to put in money towards the corporation will need at least to put in at least $1,000.
Okay.
So that means that two people can put $1,000, and then the next one can put 8,000.
Pretty low barrier to entry.
Yeah.
Yep.
Yeah, exactly. So that kind of includes family members and all that, or close friends, or right. And at that amount of money, depending on how well you are financially, it may be okay, right?
Yeah.
It's not that much of a risk. You know the person who you're investing with and all that.
Mm-hmm.
I should say, as a side note with respect to that you need to be careful, because there are securities law in New Brunswick that prevent you from just seeking those funds from the public, right?
Yeah.
So,
there's a very solid line there.
Yeah.
Yeah.
And of course, you would know that as a financial planner in terms of, it needs to be family, friends, close business associates.
Or accredited investors in some circumstance.
Yeah, but basically it needs to be from these investors. And then it needs to be there are certain restrictions in terms of what you can do. So you can't use it to repay debt or something like that. So the goal of the program, again, was really to generate revenues in the province, right?
Yeah.
You need to have a certain amount of employees in the province, or funds that are going to be used towards those employees in the province.
Yeah.
Stuff like that. It could be for buying a piece of equipment, for instance. And the maximum as it stands is $3 million per round of investment.
Okay.
Now, the provincial government, in its latest state of the province, which was just a few weeks ago, announced that they were going to, we'll say, beef up the SBITC program or modify it. I expect, because those numbers and percentages have not been changed since, again, 10, 15 years ago, that they're going to increase those numbers. And I guess I'm missing the most important part.
I was going to say, let's go back to what it does.
Yeah, so what it does really, that's nice. You can get money from friends and family.
You can raise money from close circle up to $3 million for New Brunswick based businesses, operational businesses.
Yes, exactly.
Yeah.
The advantage for the investor is that you're getting a 50% tax credit on your provincial taxes.
Oh.
So the maximum that an individual investor can invest is actually $250,000. Again, that might be increased, right?
Yep.
But basically that would mean, and you can use, it's 50% of that amount that you can use. So that would mean that there's $125,000 that you can use towards tax savings, basically. And you can go back 3 years. You can go in the future 7 years. So meaning that you can go amend your tax, your tax filings from previous year back to 3 years to adjust the provincial taxes that way. So it's kind of quite enticing for those individual investors.
Absolutely.
There's also some advantages for a corporation, but instead of 50%, it's 15%. So not as interesting. I don't want to get into rules of integration tax-wise, but that's kind of where it goes. So anyways, I'll just leave it at that for that piece.
So in a nutshell, the New Brunswick Investor Tax Credit, you're an investor, you have $100,000 you want to invest, somebody knocks on your door, says, I'm opening a hotel, I'm raising money, you want to be an investor. If they're approved under the investor tax credit, I put my $100,000 in there. As long as I've paid $50,000 in New Brunswick taxes in the last 3 years or going to in the next 7, I'm going to get $50,000 back in tax credit, basically. So half of your investment comes back to you in tax credits directly. And the interesting part is that usually you'll get paid as an investor. 3, 4, 5% rate of
Yes.
return.
Yeah.
So if I invest at 5% rate of return on my investment, 100,000, but I got $50,000 back, I'm getting 10% rate of return because it only
Yeah.
cost me 50. It basically doubles your rate of return if you think of it that way, right?
Yeah.
So it's pretty powerful tool.
There is, and then when you have to keep those shares for 4 years, so there
That's
is that
right.
restrictions as well. And
Yeah.
when you get to sell them though, and that's gonna have an impact on your your real savings, we'll say, or
Yeah.
that
Your net
calculation.
savings, yeah.
Because let's say you bought in for 100,000,
Mhm.
right? When you're gonna sell them, most likely back for 100,000,
Yeah.
right? Because it's a fixed. Usually, it's a
Usually
fixed amount.
that kind of shares. Yeah.
Yeah, and when you sell them, though, there's going to be a capital gain, but it's only on the tax saving that you receive or a portion thereof.
Right. Okay.
Yeah, so that's going to have some small impact on
There's
the
there's an
percentage.
adjustment to be made there. Yeah.
Yeah.
And usually, usually I know there's tons of ways to structure these, but usually you even have some protections as the investor. Usually you come in as a preferred shareholder
Mhm.
in the corporate structure, meaning you actually own as an investor, you own a certain type of shares that's actually kind of when it comes to the lineup of who gets paid out if there's a liquidation,
Mhm.
you're kind of right after the bank or something like that, pretty much, eh?
Yeah,
Ish,
you're going
in
to
a
be
way.
in a way you're going to be preferred, so you'd usually be before the common shares is what it
Exactly,
means.
yeah.
So upon, like you said, like a liquidation or distribution event,
Yeah.
which means that the corporation is just either
Wrapping up.
being sold or something like
Yeah.
that, you're going to get paid
Yeah.
before the common shares.
Before the normal shareholders.
Yeah, or usually the founders.
The
as well, right?
founders,
So-
etc. Yeah. Cool. So you used to teach a lot tax law, right?
Yeah.
Huh. Yeah. Okay.
Yeah. It's been a long time, but yes.
So what would be the most common mistake that you see in your practice during a corporate reorganization or the transfer or the sale of a company? So what would be like somebody's blind spot when they're going into these transactions?
I can't say honestly I've seen too many mistakes.
Okay.
The reason for that being that if somebody would say like just come to me and say, "Hey, I want to do this reorg," I'd first tell them go see a tax advisor, not just an accountant, right?
Yes. Yeah.
Or not just,
Not
but not an accountant.
a specialized
CPA,
accountant.
really a specialized accountant. So they have a background in taxes, right?
Yeah.
They did a program and all that. The reason for that is that person knows the tax law really well.
Yeah.
Better than most. There's not a whole lot of those people in the province.
Nope.
But basically, I'll redirect them there because they're going to look at all of their affairs, personally, personally, financially, but also corporate wise.
Yeah.
And, you kind of see where the corporation is going, what they want to do. Like, why do they want to do a reorg would be a big question as well. And then they'll assess the situation and then kind of dictate or provide the instructions to the lawyer.
Yeah.
Right?
So in essence, a lot of the planning's done ahead of
Yeah.
when it gets to you. You kind of get instructions and you pretty much get it done, right?
Mhm.
Legally, you have it done. So I guess if your answer seems to be get advice first.
Yeah.
Just like the main mistake is getting into something like this, selling a business, accepting a deal or whatever without having thought it through or ran it through their financial advisor, lawyer, accountant, or whatever. That's probably the chief mistake.
Yeah. And I'd say like the biggest mistake is kind of the lack of planning. So the biggest tax planning mistake is the lack thereof.
Yeah.
And I'd say in that respect, like there's a lot of, we'll say, older business owners around. And some of them, like I was just at lunch yesterday with a business broker, right?
Yeah.
So they're being approached by these people that want to sell, but they're in their older age. They don't really have anybody to sell to, which is why they're going to this person,
broker,
right?
Yeah.
But they're not set up properly.
Yeah.
In terms of being able to sell right away for various reasons. So the proper tax planning hasn't been done yet.
Mm-hmm.
And they may still be out like 3-4 years in some cases before that can be done.
Yeah.
And put properly together. Right.
Yeah.
So yeah, I'd say like people would need to or should reach out to tax advisors and lawyers, try to set themselves up before they actually want to
Yeah,
sell the company,
yeah.
right?
Be prepared,
Yeah.
and I see it quite often. And most of the time when somebody just like a business owner hits a brick wall and they're like, I'm out, I'm selling. It's either that yeah, they can't, like they don't find a buyer, they're not set up, it's not set up as an attractive purchase for the investor or the next buyer, or they have to get into some like really creative deal making, which is super risky because again, the lawyer must be like, this doesn't even work, but
Yeah.
they have to take some risks that they probably otherwise shouldn't have
No,
taken.
exactly. And
Yeah.
if I can add to that, because your question was really like, what's the biggest mistake that you see? I've seen in a few cases where, we're going, um, we need to appeal to the CRA, for instance, and stuff like that,
Hmm.
or get some, um, them to be a bit more forgiving, we'll say,
Yeah.
is
Okay.
when a business owner doesn't have an accountant,
Yeah.
or doesn't file, for instance, an HST return,
Oh, yeah.
source deductions for employees, stuff like that. So
Hmm.
it's really important to basically meet up with someone who knows what they're doing so that they can explain it to you.
Yeah.
If you want to run it by yourself after, I mean, that's fine, right?
Yeah.
And I get it, like, it can be expensive, but if you're explained properly from the onset,
Hmm.
you're not going to make those mistakes. And I've seen, like, I've seen some people owing in the hundreds of thousands of dollars because they just didn't know any better,
Oh,
right?
CRA, you mean? Yeah, in
Yeah, to
HSTs.
CRA. Yeah,
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 yeah.
exactly.
Having that set up and understood is absolutely massive. Yeah,
Yeah,
from the onset for
yeah.
sure. Um. All right, we talked a little bit about shareholder agreements. What would you say are some of like the non-negotiable clauses that every shareholders agreement should have um, to prevent, the worst case scenario? So, what are like the key ones you like to see in there and done properly?
So you want to have for sure, I'd say, like, who's going to be named the director, right?
Okay. Yep.
And basically, a shareholders agreement also takes some rights or some obligations from the directors. They're going to put it on the shareholders' back,
Hmm.
right? That's one of the big concepts of that document. So again, you want to dictate who is responsible to do what,
Yep.
right? It may be tied to an employment agreement with that person and the corporation
Yep.
as well,
Hmm.
which you want to, again, you want to tie it in and mention it in the unanimous shareholders agreement. So what happens basically if that person is no longer an employee? Do they remain a shareholder, for
Yeah.
instance, or not? And then the mechanism to get that person out if that happens,
Hmm.
right?
Hmm.
If it's a closer knit company and we're talking just 3-4 people as shareholders, that may not be really as much of a question. But
Hmm.
anyways, I'd say the debt clause or incapacity clause would be a big one. So
Hmm.
if something happens to one of one of these individual shareholders,
Hmm.
what is to happen, right?
Yeah.
So usually what we'll do is that there will be an option for the corporation or the other shareholders to buy that person that's incapacitated or
Okay.
deceased,
Yeah.
to
Deceased,
buy their
disabled.
shares.
Yeah.
Yeah, exactly.
Yeah.
And Marcel, I think you may come in here in terms
Mhm.
of, and you've seen this before, but this is where having a good life insurance that
Hmm.
can be bought by the company
Yep.
uh, for an individual shareholder, we'll say, can be useful,
Yeah.
right?
For sure. Like that's one of the places where I help business owners a lot is, in the shareholder agreements often that we work on together. Insurance, yeah, can play a role in making sure the corporation has money to buy out the shares. And I think, insurance plays a key role in shareholder agreements because, yeah, what happens if they're disabled? What happens if they get sick? What happens if they can't contribute? Your partner, two people partner, and one of them can't work for 10 years. What does the other do? Like,
Mm-hmm.
so I think it's super important for shareholders agreements to mention insurance and say, okay, well, we both need disability insurance. Corporation has critical illness insurance. Corporation has life insurance, and this is how it's going to be used should A, B, or C scenario
Yeah.
work out. So I think that's totally huge.
No, so I'd say that. I'd say just generally the dispute resolution or mechanism that I mentioned earlier, that can be quite useful just to, again, dictate what is to happen. So, usually you'll have some good faith negotiations, right?
Yeah.
But you're pretty much past that if you're going to bring up the shareholders agreement anyways. You still mention it in there, but we'll say we'll give like 10, 15 days to do that. And then we'll move on to either of mediation or arbitration, which is, you're kind of bringing in someone else to, as a mediator, either assist with the conflict or as an arbitrator to make a decision.
Yeah.
And then obviously, depending on which situation, you could also go to court. Before that, even, you could have some buy-sell mechanism.
I was going to say buy-sell, shotgun.
Yeah, exactly.
Yeah.
So the shotgun, which is basically like, I'm offering to, it could be either or. So I'm offering to buy your shares, or, I'm asking you to buy mine. Usually the former, but
shotgun's a great clause.
Yeah. As you would know.
I mean, it's just a good clause. It protects both parties. It prevents a lowball offer. Do you want to explain how the shotgun offer works, basically?
Yeah. So basically, if we go with the former approach, we'll say, so I offer to buy your shares for a certain amount.
Yeah.
Right. But then the agreement will say that you then have a certain amount of days. We'll just say like 20 days for the sake of it, to either match that offer or say you're going to buy them.
Yeah.
From me instead, right?
So exactly. Either accept the offer or buy, or I'm forced to buy at the same share, right? Yeah. So basically, if you make a lowball offer, the person can just say, all right, well, I'm going to take that offer, but opposite, I'm going to buy you out for that great deal, right? So it prevents the lowball offer, which I like. And also the other buy-sell, which is, again, on the death of a shareholder. So when we talk about estate planning and stuff, I think the buy-sell agreement and how it's to be liquidated and which shares get redeemed and all that stuff is super important for not only for the business owners, but also for the families who probably rely on the equity and the capital within that corporation to flow to the family, ideally in a tax-efficient way through the CDA account if life insurance is into play. And that's I think that's just good business. Yeah, for sure.
And then I'll just add to that, Marcel. So there could also be some other triggering events, right? So we talked about incapacity, we talked about debt. There could also be some family-related questions, right? So if the person is married, one of the shareholders or some shareholders are married, there could be some mechanism in there to protect those shares in the event of a separation or divorce, right? Just so that, the spouse, it shouldn't usually work that way, but just to ensure that the spouse doesn't get, 50% of those shares, for instance.
Controlling share.
Yeah, exactly.
Yeah. That makes a lot of sense. Moving on a little bit to real estate and real estate transactions. So in a business sale, so let's say you have either a real estate portfolio or even just business assets, like an operating company. What would be key considerations when you're choosing between an asset sale or a sale of shares, basically? And when in real estate, it's usually owned in a corporation, right? So you can technically either sell the asset in sometimes, like even in like if you own a garage or something, you could sell the assets as opposed to the shares of the business, which is basically the whole business. Yeah. Can you maybe distinguish between both and what are the pros and cons of those?
So I'd say, like, from a vendor perspective, you probably want to sell the shares.
Yeah. Sell the whole thing.
And we'll just say that generally, like, it could be an active company, like a, business with operations that, you make something, for instance, you're a planner or something like that, or you own a gym or, but it could also be passive, which is more like, it could be dividend, it could be real estate, like you're saying.
Yeah.
From a vendor perspective, again, you want to sell those shares. And usually, because you're selling everything, the whole block, right? Get rid of everything. Exactly. There's no questions. There's
everything
nothing.
Comes with the shares.
Yeah. Yeah. From a purchaser perspective, depending on what it is, sometimes you'd rather have the assets. And the depending part is, if you want to have we'll say the goodwill.
Yeah.
Right. which is usually the client list and some intangible assets, we'll
Yeah.
say.
Brand.
Like it's just the brand of business. Yeah,
Yeah.
exactly. So then you'll want to maybe buy the shares.
The whole thing.
But otherwise, you may be more interested in just the assets, because then you're just buying these assets. We can do some due diligence on those to ensure that nothing is attaching to them, and that's it, right?
Right.
A lot less of a risk compared to
Yeah.
a share transaction.
Yeah, I mean, I guess if I'm a buyer and I'm just looking to increase capacity, let's say I'm a manufacturer, maybe I just want to buy the building, like maybe I just want to buy the factory, and I don't necessarily want to inherit the payroll
Yeah.
and the brand reputation and the name. I just want the building and maybe the option to pick up a few staff. Right?
And I mean, like, without getting into the nitty gritty of that, it can still be done, and there's some protection that can be put in place in a good purchase and sale agreement, but some of the stuff may still be up in the air, right? You can protect yourself with some kind of a holdback in that agreement, meaning that you're going to put aside some money that if nothing comes up, we'll say, in the next few years after the transaction, it goes to the vendor. If something comes up, there's litigation or whatever that the vendor may have known but was kind of up in the air.
Right.
It comes about, well, then you can use that holdback to pay that, and then you get the balance to the vendor.
Okay.
The other big piece for a vendor, though, to want to, if we go back to that, if we want to sell, would be especially if it's active. So we're not necessarily talking real estate or a passive portfolio,
a business
like
that runs.
Yeah, a business that runs. Then you could also, that's where you have access to your capital gains exemption.
That's right.
Right. So if you sell, you've owned those shares for at least 24 months. Right? Or you were the only owner in that 24 months. Yeah. It's an active business. Well, you may qualify for the capital gains exemption,
which is $1 million.
Yeah. So meaning that you may not have to pay much capital gain or much taxes on the transaction.
Yeah. But that has to be an active business, right? That's another key thing is it can make a lot of sense to move your capital. That's another reason we use Holdcos too, right? Is because you move if too much money builds up into an active corporation, it no longer qualifies as an operating or it's no longer necessarily considered a small business or qualify for the small business tax credit, might not qualify for the capital gains exemption on a sale. So a Holdco is often used to purify, so to take cash assets or investment account assets, passive assets that make money without being an active business, and leaves the operating company as what we call a pure operating company, so that if that operating company is sold, you can benefit from the lifetime capital gain exemption, as opposed to a holding company cannot be sold and benefit necessarily, I'm not sure, from the lifetime capital gain exemption.
No,
am I right?
That's a fair point. And, to go back, because that was an earlier question of yours as well in terms of purifying. But what you're really doing is you're stripping the company from cash, because again, to your point, the capital gains exemption cannot be used to buy cash, right? They don't want it to be used for that, right? Because that would be easy. So like you just leave a bunch of money there, don't pay the taxes on it, and then that's basically what ends up happening, right?
Yeah.
Because you get a capital gain, you get the exemption. So obviously the government doesn't want that. Yeah.
They don't want just a tax-free cash transfer to your pocket.
Exactly.
Basically, yeah.
So you kind of strip or reorganize the cash, purify it if you want. From there, you can put it in Holdco, which is usually what's going to happen. You can also just flow it as dividends or in various other ways to the shareholders before that exit transaction. We'll say.
So what actually ends up flowing through the lifetime capital gains exemption is the goodwill, the assets, the actual stuff that makes the business run. I mean, cash is essential, but you can only have some cash. What is it, like 10%, I think?
I believe it's around that range. I can't say exactly, but yeah.
Yeah, so cool. So staying on the real estate side of things, I work with a lot of professionals, doctors, lawyers, etc., that often, they have good cash flow. They're starting to have assets or cash accumulating in their business, and sometimes they want to buy real estate, diversify their investment portfolio, and the idea comes to, well, why wouldn't I invest in real estate and then rent my own office space
Mhm.
like from myself, right? Or to my colleagues, or open my clinic in my own building. Is there any considerations to somebody wanting to do that? Should it all be done in the same corp? Should it be done in separate corps, and why?
So the first big thing, and again, I'll redirect to my friends, the tax
Yes,
advisors,
of
on
course.
that. So first question would be that, right? Does
Why?
it make sense? And to some extent, even to you, to a financial planner, right?
Yeah.
Does it make sense? Is there going to
Mhm.
be actual extra cash and all that? Um, it can be advantageous and it can make sense because if the shareholder owns that corp, usually I'd recommend, by the way, two corporations. Yes, so the real estate would be owned in something different. If we're talking usually a professional, so if you're talking accountants, lawyers, doctors, dentists, optometrists, and all that,
Mhm.
yes, you'll want to keep it in. You'll have your professional corporation anyways.
Yeah.
You'll want to keep those two separate,
Separate.
right?
Mhm.
And then in the real estate, there's a good chance that it's not only going to be your clinic, right? There could be more businesses in there, right?
Mhm.
But yeah, so I'd recommend doing these two.
Separate.
Um, yeah, and I mean, yes, it could be an advantage because you're again, you end up paying yourself at
Your
the end
own
of the day,
rent.
right?
Yeah.
So instead of paying rent, which is just
Yeah.
sure you can expense it, but it's gone after, right? So,
Yeah. Absolutely. But you do gain the headaches and all that good stuff.
oh yeah, yeah.
Okay, I'm gonna shift to. We're gonna start wrapping this up, but I had a few last questions I like to ask most people who come through here, or at least I'm gonna start asking people who come through here. What's the best and the worst advice you've ever received?
In terms of
Anything, business, life, doesn't matter. What's the best advice you've ever received?
don't be afraid to say that you don't know
Good one.
and go seek the advice. And that's especially true. Like now, I'll speak to young professionals. Whatever you do,
Yeah.
right? It's not just this is not does not just go for legal. If you get a question from a client or somebody you're dealing with and you're just not sure, don't be afraid to tell them
Yeah.
and go seek that advice from a professional who actually knows.
The experience.
I'd say that will go a long way.
Hmm.
And then don't be afraid. It kind of ties into that, but don't be afraid to put in the time to
Hmm.
properly learn your trade,
Yeah.
right? So
Go deep into your
yeah,
lane.
and it can be hard, it can be tough, it can be long, but the more you do that from the onset, the better the payoff, and it's an investment in yourself,
Yeah.
basically, right? So
100%. Um. All right. Well, I think we'll end it there, man. I really appreciate your time, and look forward to watching this and hearing the feedback. All right. Thanks for
great.
coming in, man.
Thanks,
Okay, cheers.
Marcel. Have a good one.